Housing inventory just hit a 15-year high, while mortgage applications dropped 30% year over year. Right now, at this moment, homeowners who bought properties in 2021 and 2022 are trapped underwater, holding mortgages worth more than their homes. We're looking at $2.3 trillion in homeowner equity that could simply evaporate by 2026. Let that number sink in for a second. $2.3 trillion. But here's where it gets worse. This isn't just about interest rates anymore. We're watching a perfect storm develop, and most people are only seeing one piece of it. Insurance costs have surged 400% in some states. Property taxes are climbing at rates that outpace inflation. Maintenance costs are skyrocketing, while wages remain stagnant. You've got homeowners bleeding money every single month just to keep properties that are declining in value. The math doesn't work anymore, and everyone knows it, but nobody wants to say it out loud. Then there's the shadow inventory. Millions of homes being held off market by institutional investors, waiting for better prices that may never come. These aren't homes, they're assets on a balance sheet. And when those balance sheets need rebalancing, guess what happens? Mass liquidation, all at once. And here's the contradiction that should keep you up at night. Despite everything I just told you, home prices are still rising in 40% of markets. How is that even possible when every single indicator points toward collapse? The answer involves something the Federal Reserve doesn't want you to understand about how housing data is actually calculated, and why the numbers you're seeing might be telling you a completely different story than what's really happening. Let's talk about what the data actually shows when you dig beneath the surface. The median home price to median income ratio right now sits at 8-to-1. Historically, that number has been 4-to-1. We've doubled the threshold of what's considered affordable, and we're pretending this is normal. 40% of recent home buyers have debt-to-income ratios above 43%. That's the subprime threshold. We're literally recreating the conditions of 2008, except this time everyone's eyes are wide open and we're doing it anyway. But this isn't 2008, this is something different, something potentially worse, because we're dealing with 4 simultaneous crises that are about to converge. First, the insurance crisis. Climate risk is being repriced in real time, and entire zip codes are becoming uninsurable. In Florida, homeowners are facing $10,000 annual premiums or more. You cannot get a mortgage without insurance. No insurance means forced sales. It's that simple. The cascade effect is already beginning. Second, commercial real estate contagion. $1.5 trillion in commercial mortgages are maturing between 2024 and 2026. Regional banks hold 70% of commercial real estate debt. When those loans come due and properties can't be refinanced because they're worth half what they were, those banks face insolvency. This is the savings and loan crisis all over again, except the scale is exponentially larger. Third, the institutional investor exodus. BlackRock, Invitation Homes, the so-called smart money, they're quietly reducing positions. Rental yields are turning negative in major markets. When the algorithms say sell, they sell without emotion, without hesitation. And when the smart money leaves, retail investors holding single-family rentals get absolutely crushed. Fourth, the demographic time bomb. Baby boomers are entering the forced liquidation phase. Healthcare costs, downsizing, estate settlements. They need to sell, and they need to sell soon. Meanwhile, millennial and Gen Z homeownership rates are 15% below historical norms. You've got more sellers than buyers, and that gap is widening every single quarter. Population growth is slowing. Basic supply and demand tells you exactly where this goes. The regional domino effect is already visible if you know where to look. Phoenix, Boise, Austin, they're showing 10 to 15% corrections right now. These are the canaries in the coal mine. The pattern follows a predictable sequence. Sunbelt speculation markets collapse first, then over-leveraged metros, then suburban sprawl, then everywhere. Regional banks with heavy exposure to these markets are the most vulnerable, and their balance sheets are already showing stress. Here's why this time genuinely is different. 2008 was a lending crisis. We had bad loans to unqualified buyers. 2026 is an affordability crisis combined with structural problems that can't be fixed with monetary policy. There's no political appetite for another bailout. The extend and pretend game that kept zombie loans alive is ending. Forbearance programs have expired. And there's a moral hazard question nobody wants to address. Should taxpayers bail out institutional investors who knowingly overpaid for assets? Now let's be clear about something. Not every market will crash equally. Some markets with strong job growth and genuinely limited supply will weather this. But the math doesn't lie. Current prices require either massive wage growth or a return to 3% mortgages. Neither is happening. The soft landing narrative requires everything to go perfectly, and historically that almost never happens. This affects everyone, not just homeowners. Renters face instability, local governments lose tax revenue, and here's the bigger issue. Home equity is the primary wealth store for most Americans. When that evaporates, you're looking at a retirement crisis on top of everything else. Add in automation and AI job disruption, and you have to ask, who exactly is buying these houses in 5 years? So here's the ethical dilemma. Do we prop up unsustainable prices to protect current owners, or do we allow a correction to restore affordability for the next generation? There are no easy answers, but ignoring the data won't make it disappear. The signs are all there. The question isn't if anymore. It's when and whether you'll be positioned to survive it.